Provided you risk manage and you control your emotions, volatility should be embraced by traders.
Carlo, welcome to Forbes in Focus. You've had decades of experience in senior trading roles. Based on your observations, how do market disruptions and uncertainty impact markets, and how can traders prepare themselves for whatever may lay ahead?
Yeah, market uncertainty and disruptions, such as we're seeing today, can lead to high volatility. You can get some fast and big price swings. A lot of traders might experience fear and anxiety, which could cause them to make decisions based on emotions rather than logic and data. But I feel on the flip side, volatility can be a trader's best friend, because volatility can lead to valuable opportunities. And provided you risk manage and you control your emotions, then volatility should be embraced by traders. Have a decent amount of capital set aside so that it is there ready to act when these opportunities arise.
How can traders mentally prepare for what turbulence lies ahead?
So firstly, traders accept that volatility is part of trading, and during these uncertain and turbulent times, traders need to be more emotionally resilient. As new information comes to hand, we need to be able to analyse and process that new information, new data very quickly, and not become paralysed by uncertainty. Have emotional detachment from those trading outcomes, those profits and losses that you make.
It's been said that trading is 80% psychology and 20% skill. What is emotional mastery, and how can it help to achieve a better result when trading?
So emotional mastery means being aware of your emotions and then learning how to control them so they don't get into the way of your decision making. So what I'd say is, if you put a series of trades on, then have an exit plan. Quantify the amount of profit you'd like to make per trade and stick to that level. Place a take profit on the platform. And similarly, quantify how much you'd like to risk per trade. Place a stop loss on your trades and leave those levels there, and let the market hit your take profit and stop loss. And be unemotional when executing your trades.
How can emotions like fear or overconfidence impact outcomes? And what are some of the tools or strategies that traders can use to combat this?
So fear can cause traders to exit profitable positions way too early, which is one of the tough things in trading, that every trader kicks themselves after the event. And fear can also stop traders from placing trades that make sense because they don't want to be wrong. Overconfidence tends to happen after a series of profitable trades, and overconfidence can lead to excessive risk-taking or ignoring some of the warning signs that you might be on the wrong path. Now, to combat some of these emotions of fear and overconfidence, or as we say, fear and greed, traders may consider risk management techniques, such as the use of a multitude of stop losses, whether it be regular stop losses, trailing stop losses, or guaranteed stop losses, which are pretty powerful. Secondly, journaling. So writing down your trades, but more importantly, why you took those trades and how you felt at that time. Seeing these things can help internalize some of those emotions and uncover any emotional pattern that you may not be aware of.
What are some of the cognitive biases that can cloud decision making?
Loss aversion is the big one. And loss aversion means being more afraid of losing than being excited about winning. And that's where they might get into trouble. Secondly, confirmation bias. So looking for information which supports your trades, your views, and disregarding any contrary information. And thirdly, overconfidence bias. And that is typically happens after a series of profitable trades where you have that feeling of invincibility, that you can't do anything wrong, and you believe in your predictive capabilities more than what you should do.
If there's one key takeaway on the psychology of trading that you could leave our viewers with, what would it be?
I think discipline is everything. Manage your trades effectively, manage your emotions, stick to your trading plan, get in there and trade. If you have a passion for trading, get your hands dirty, because the only way to learn is by making profitable trades and also taking some losses on the way as well too, which is part of trading. And the goal of trading is to achieve consistency, especially in these turbulent and chaotic markets that we see today.
Carlo, thank you so much for coming along today and sharing those insights.
Rebecca, thank you. Thank you for inviting me. It's been a pleasure.